Hello friends, today we are going to see the new topic, that is PE ratio, that is price earning ratio. What is the price earning ratio wants to indicate? The price earning ratio wants to indicates that how your market price per share of your stocks, is getting affected through the earning per share. Whatever the earnings the company is earning for its shareholders, that is been described in the financial statement. Now based on the EPS, that is the earning per share of the company's market price also fluctuates. What is the reason for such fluctuation? The reason for such fluctuation is simple, that if the company is doing well and the company is on a growing stage or has attained a certain level of growth, its EPS, that is earning per share, will indicate the same. It will be mainly indicated through its EPS. And if the existing shareholders or the potential investors of a particular company will try to see that yes, the company is growing every year, the company's EPS is increasing, and the company has attained a real growth and is at a very good position, and that is the reason the people or the potential investors will start investing in that particular company shares. And as a result, what will happen, the demand will increase, and due to the increase in the demand, there is possibility that the price of the shares might increase in the stock market. Now in the reverse case, if the company is not doing well, it will be indicated through the EPS available for the equity shareholders. Now if the EPS has been declining stage from a long time, the existing investors will start withdrawing their investment from the same company, and as a result, in the market, the supply of that particular company shares will increase, and as a result, the market price of the particular share will go down, and as a result, the company may face a loss of a lot of scarcity in the given future. Now what is indicated through price earning per share? That is only indicated. Price earning ratio wants to say that due to the change in EPS, due to 1% change, or we can say $1 change in EPS, how much is your market price per share has been affected, how much is your market price per share has been affected, and that is been shown to PE ratio, that is price earning ratio, that how your market price per share is affected due to the earning per share. Moving forward in the same direction, there is a concern for the company regarding the negative P ratio. Sir, how come the negative P ratio can come? Sir, the negative P ratio can come due to if the EPS is negative. Now, if the EPS is negative, its P ratio will also get negative, and as a result, it will create a disastrous effect for a particular company. That means the existing investors in a particular company will start withdrawing their investments, and as a result, the company may start declining its growth, and as a result, in a given time period, there may arise a condition that the company may be required to be liquidated. Now this is a warning sign, this is a red signal, a red alert for a particular company if its PE ratio is a negative form, because its EPS is going in a negative form, and the company should take necessary and suitable steps. Companies should take necessary and suitable steps so that the negative EPS can be converted into the positive EPS for the company, and the positive EPS can give you the positive PE ratio, and as a result, the company can make a growth and can have the trust again, and can build the trust again within its investors. Now this is the situation which the company is required to take into consideration. Moving forward in the same direction, what does it want to say? So there are some types of P ratio, or some of the types of P ratio that we need to discuss, that is the forward and trailing P ratio. So we will try to analyze the same. What do you mean by the term forward? Forward means that we will look forward, or we are looking for some future prospects in the company. And as a result, what will happen, sir? Due to the future prospects, the company is able to show to its users of the financial statement. The company is able to show to its users of the financial statement that yes, the company is looking forward, and this is the company's estimated projection, and the company is going to have a good growth in the future. So this can be shown through various projects which are being sanctioned to the company by the government, or any appreciation or any such type of thing, or any development has taken place which shows a positive sign for the company, and so the investors are getting a hint that yes, in the coming future, due to such reason, the company is going to make a particular type of investment and the company is going to get a particular type of growth. Due to growth, EPS will increase, and due to EPS, P ratio will increase, and that is the reason so it has been shown as a forward and trailing PV. Now we will discuss the trailing PE ratio. Sir, what do you mean by term trailing PE ratio? So the trailing PE ratio wants to say that the sir company is showing its past 12 months data, and based on that past 12 months data, the company will show its results. The company will show its result, and it will be shown in the form of PE ratio. Now in the forward and trailing, the common thing is that the company is going to have the company is going to see the data of the 12 months only. Means in the forward, the company is going to see the data for the next 12 months, which is the prospect for the company, and for the last 12 months in the trailing P ratio, the company is going to see the prospects of the same. Now we will look into the theoretical portion. What does it want to say? So it wants to say that trailing P ratio, trailing, that is a 12 months of earnings a company will show. It is a historical account of this ratio. It is a historical account of the ratio. And what do you mean by term forward P ratio? The forecast of earning over the next 12 months that we have discussed. What, why sir the company is telling about the forecast of the next 12 months, and so it provides a forward looking matrix for the company. It provides a forward looking matrix for the company. Now moving forward, sir, in the same direction, a new ratio that we are going to discuss is the price to cash ratio. Price to cash ratio, what does it indicate? See, the price of the company can be affected through various ways. Price of the company can be affected through various ways, but still the company on and its investor wants to know that how much is the cash availability, what is the cash availability with the company as compared to price. Sir, why sir? Because the more the liquidity with the company, more its financial statement would be stronger, would be fair, would be faithful, would be more presentable, and as a result the investors will have a trust on the company that the company is doing well business, the company is having a growth, and that is the reason the company is having a so much amount of liquidity with it, and as a result sir the company's market price can fluctuate in a significant manner, and that is been shown through the price to cash ratio. We will look into the theoretical portion. What does it want to say? It wants to say that sir it compares the price of the company stock to its cash flow. Yes sir, we are making comparison. That means sir, as compared to our cash thing, as compared to our cash portion, how much amount of company stock is available. Moving price is available. Moving forward, what is the formula? So market value of share divided by cash flow per share. Cash flow per share. That is sir, the investors, existing investors should be aware or should be relaxed that yes, not an issue if the company today goes into the liquidation. If the company today goes into the liquidation, then there is nothing to worry, the company can have, the shareholders can have their shares at a reasonable price. That means at the time of liquidation, company will be in a position to pay to its shareholder. How much amount the company will be able to pay its shareholders per share basis, that will be derived through cash flow per share, whose formula which will be seeing it in now. Now market value per share divided by cash flow per share. Sir, as we have discussed earlier, sir, whatever the sir in the given formula, whatever things are given in the denominator, that is the base thing. That is the base thing due to which the numerator has been affected, and that is been shown that if the cash flow per share availability with the company is more, the market price would be more fluctuating, because the investors would be having a faith or trust in the company that yes, company is a solvent company, company is a liquid company, company is in a position, if on today the company goes into liquidation, it is in a good position to pay its shareholders on a reasonable amount or a good amount, and that has been shown. Next thing sir, cash flow per share, we would like to see. Cash flow per share is the amount of cash company is having on hand, as on hand company is having after taking depreciation into account, because depreciation is a non-cash expense, then just we have to make the adjustment of the same to derive the cash flow per share availability to the shareholders. Next topic that we are going to see is the dividend yield ratio. What do you mean by term dividend yield ratio? That due to the dividend portion, how is the market price has been affected, that is been shown through the dividend yield ratio. Now let's see the theoretical portion and we'll try to understand it further. What does it want to say? It wants to say that it measures the amount of cash dividends. It measures the amount of cash dividend distributed to common shareholders. It measures the amount of cash dividend distributed to the common shareholders related to the market price per share. Now if we look into this formula, that is a dividend yield percentage, what does it want to say? It wants to say that's a market price per share divided by dividend per share into 100. Now see friends, let's try to understand what does it want to say. Sir, it wants to say that if a company is declaring dividend, if a company is declaring a dividend to its shareholders, it's such news will be spread out all over. Now what does it indicate? That a company is having a sufficient amount of profit, current years plus as well as accumulated profit. The company is having sufficient so that it is in a position to pay the dividend to its shareholders, so that it is in a position, to pay dividend to its shareholders. Now what will happen? Due to the payment of dividend to the shareholders, the company due to the payment of the shareholders to the company, the market price of the shares will also start to fluctuate, because the potential investors will see that yes, the company is paying a good amount of dividend every year, and so now why not to invest in such a company, and as a result the company's market price will start fluctuating in a respective manner. Now in the reverse case, what will happen? If the company is not paying dividend, the company will not be able to have much investor, because the investors are at the end of the period, at the end of the day, are investing just to get the returns on their investment, and as a result, if they will not get the investments output or investments return, they will start withdrawing their investment from the given shares, and as a result the company will not be in a position, or company may not be in a position to function more in a appropriate manner. Moving further, what does it wants to say? A new ratio, that is a dividend payout ratio. What do you mean by term dividend payout ratio? That if a company is earning $100, company is earning $100, I am assuming this amount after deducting all my expense, all my liabilities and all such thing, I am assuming that company is earning $100, and out of the $100 the company had decided that I will pay out $50 as my dividend. That in the form of dividend I will pay $50. Now what will happen? The company is actually paying out of its profit the actual amount of profit, and it will be through its net income. That means dividend payout ratio, the dividend payout ratio will be calculated, and related with the net income of the enterprise. Moving forward, sir, looking into the theoretical portion, what does it want to say? It is a ratio of the total amounts of dividend paid. It is the ratio of the total amount of dividend paid out to shareholders in related to the net income. That means if the company had earned if the company had earned a income of $100, the company will pay out $50 in the form of dividend to the shareholders, and as a result it would create a positive effect on the company's performance as well as in the reputation. Now percentage of earnings paid to the shareholders in dividend, this is also known as percentage of earnings paid to the shareholder. That means today I have paid 50% of my earnings to my shareholders. Means in the current year I have earned $100, and out of $100 I am paying out $50 in the form of dividend, and as a result I can say that I have paid out 50% of my amount to the shareholders. Now if I look at the formula, dividend payout ratio is equal to total dividend divided by net income. That means as compared to my net income, how much amount of total dividend I have paid out to my shareholders, that will be depicted through this. Next, even it is be said that, sir, if I am earning $100 and if I have decided that I will retain $50, I am assuming, okay, let's change the example. If I have earned $100 and if I have decided I will retain $60 with me, that means I can say that I am paying out $40, and that is why that is what the second formula wants to say, that is a dividend payout ratio equal to 1 minus retention ratio. Whatever is your retention ratio, that is the balancing amount from the retention ratio will be paid out to the shareholders in the form of the dividend. Next thing that we want to say is the dividend payout ratio equal to dividend per share divided by earning per share. So dividend per share divided by earning per share, what does it want to say? That as compared to earnings of $100, that is our total earnings, and if I am assuming that my earning per share is $10, that means as compared to my $10 income, how much amount of dividend per share I am paying out to my shareholders. As compared to the earning of my $10, how much amount of earning I am paying out to my shareholders in the form of dividend, that will be shown to the dividend payout ratio. Now if we look into the another formula, sir, what does the dividend payout ratio wants to say? Sir, dividend payout ratio wants to say it is equal to dividend divided by net income. That is one of the formula that we have discussed, but still it is the main formula which is being used in a generalized way. Other formulas are also being used, but this is the formula which is used in a generalized way, and as a result, sir, it is been depicted separately in the given form. Next, sir, if we consider the next thing, what is the total shareholders return? So, what do you mean by the term total shareholders return? The total shareholders return wants to say that it is a total return of a stock to an investor. Now, looking from the investor's viewpoint, now if you look from the investor's viewpoint, what does it want to say? It wants to say that the investor will be highly affected by the return. Investor will be highly affected by the return he will be getting. He will be highly affected by the return he will be getting on its investments in the shares, and as a result we need to think from the investor's viewpoint, because as much as amount of more return the investor will get, we would be in a position to have the total return on the investor, and the investor will have a trust on us that yes, the company is thinking from the investor viewpoint, and yes, we should invest in the given company. Moving forward, sir, it is a capital gain. It may be either through capital gain, that means that shareholders return can be in the form of dividend, can be in the form of capital, anything. Sir, how capital gain? Because sir, if the company if the shareholder says invested $10 in year one, and the company is growing well, the company's EPS is great, company's dividend payout ratio is great, and so on. If the shareholder has invested $10 while purchasing the share, and within a time span of 1 year the company's market price has gone to $100 per share, that means the investor is able to have a benefit of $90 that is a capital gain. Now he would be very happy that yes, the company is earning so much that today I am having a gain of $90 with me, and plus dividend, whatever the amount is that the company is paying, the investor is having such dividend also. It is the internal rate of return for all cash flows to the investors during the holding period of an investment. What does it want to say? That the investor will be expecting a certain rate of return internally, that is the best rate of return during its holding period of a particular investment in the company. Yes, sir. When the investor starts investing in a particular company, they are having a mindset, or they are having a target in their mind that the company will earn X percentage of profit, or company will earn X amount of profit in the given time period, and as a result I will keep my investment I will keep my investment for a given time period. Then yes, it is the company's responsibility to now fulfill the desire of the shareholders and work according to their expectation. Internal rate of return, that is yes sir, the rate of return which is been generated by the company internally, and which is larger than the external one. Now if we look into the total shareholders return, at the end of the day, the total shareholders return depends on the company's growth, company's sales, company's various credit policies, company's various payment policies, company's loan sanctions given, company's leverages. What do you mean by this? Leverages, if I talk about the term leverage in a simple language, that means a leverage means the risk available with the company. And yes, all such things plays a vital role. In determining the company's growth, and that growth help us to derive or come near the total shareholders return, which is the shareholders expectation from the company. Moving forward in the same direction, what is happens, sir, if we look into the three, sir, sales growth, margin improvement, sir, assets efficiency. Yes sir, your assets should be efficient so that you are able to have the more production of goods, and sir, you can have a more quality of goods, and yes sir, your margin will automatically improve and your sales will automatically improve, and sir, it will be related to the cash flow growth, your company's growth, and all such things cumulatively will result into the total shareholders return. All such things cumulatively will result into the total shareholders return, and this is thing we need to understand, and this is the main thing for which the company or the shareholders are making investment in a particular company. Moving forward, new topic, that is earnings yield. So what do you mean by term earnings yield? Yield means the output. In a simple language, if you want to say, so yield means output. Earning yield equal to EPS divided by stock price. EPS divided by stock price. Now, so what will happen? What will happen over here is there is a relationship between them. What is there? Sir, in the given formula, it has been given that the stock price is in the denominator and EPS in the numerator. That means based on your stock price also, your EPS will also depend. Sir, how it is possible? Because if the company stock price are constantly falling, the company will be aware that yes, something wrong is going on, and the shareholders are not at all, or the security holders are not at all happy with the company's performance. And now let's have the growth in the company, or we need to find out where the problem is and find the solution according to the same. And as a result, the company will start its growth, the company will start its production process in a more efficient manner. Company's EBIT, margin, efficiency, the company will look into all such matters and will try to improve the same. And if in totality, if the cumulative effect is given, if all the things are being taken into consideration, this thing will result into increase in EPS. That means if the stock price will increase or the stock price will fluctuate, the company's EPS are also going to be affected, and how much it will be affected, it will be shown at the on the balance sheet date. And that is the reason, sir, earning yield percentage, sir, shows a very good concern for the company, that if the company is little bit not performing properly, the EPS or the EPS or the shareholder will start immediately reacting to the same. Next topic that we are going to look, that is the leverages. So what do you mean by the term leverages? Leverages means, in a simple language, if I tell you, it is a risk. It is a risk for the company. So what type of risks are you are talking about, sir? If you Google out the meaning of the same, it will have a different variety of meaning. But in a simple language, if you want to understand what do you mean by the term leverage, leverage means risk. Risk means, sir, what type of risk the company is having. So see, the company is mainly dependent on its sales income. Company is mainly dependent on its sales income. And sir, assume a situation that if the company sales are going in a declining way, the company's income, if the company's sales are declined, what will happen? Company's operating income will start declining. Company's income will start declining, that is the net income will start declining. And if the net income will start declining, what will happen? The company's EPS would be affected greatly. Company's EPS would be affected greatly, and that is the reason company is having risk. If the sales goes down, in effect the company EPS will go down, and as a result, if the EPS will go down, the company's market price per share and all such things will go down. That is the point at which the company has risk. First risk the company is having, that the company's sales will decrease. Second risk the company, if any, not all the companies, but majorly companies are facing, that is regarding its capital structure. Sir, what type of risk are they are having about that capital structure? The company is having a risk that in its capital structure or in the capital employed by the company, if the more amount of debt securities are there, then the company is under the tremendous commitment for its fixed charges. Fixed charges like interest, company had to regularly pay interest, bonds, company had to pay regularly interest on bonds, debentures, and so on. That means, even though the company's sales are very good, but if the company is laden with the more amount of the fixed commitment, it is at the risk that the company may not be in future able to in future may not be give the enough amount of EPS for the company. Now what will happen with the horizon of debt in the company's capital structure? The company is under a mindset that at least I need to earn so much of amount that I am able to fulfill my particular type of commitment, that is the interest commitment. If I specifically say, company will be under the pressure that it is required to earn at least so much amount that its capital commitments are fulfilled, that its commitment which has given to the shareholders and to the lenders of the company and so on, so that it would be not in a situation to make default in its payment of the various type of expense. And that is the reason a leverage arises on the company based on sales, sir. Based on sales and based on any type of capital commitment. And yes, sir, in both the type of leverages the company is facing, the company will have a foremost and the important effect on EPS only, because at last EPS has been derived after deducting all your expenses, all your commitments, all your liabilities and all such things. Last effect will be on EPS, and this is how the leverage has been divided into three parts. First is degree of financial leverage, second is degree of operating leverage, and third is combined leverage. Combined leverage is nothing but it is the combo of degree of financial leverage and degree of operating leverage. What will happen now in the degree of operating leverage? The company is under the threat that if the company's sales will decrease, company's operating income will decrease. That will be called under operating leverage, degree of operating leverage. Whether the company is under the leverage or not, that we need to decide. according to the formula which will be discussed in the later session. Degree of financial leverage. If the company is laden with the if the company is laden out with the fixed commitment charges, how it is going to affect the EPS of the company, that will be shown to in a ratio manner through this through this degree of financial leverage. And in the last degree of combined leverage, we will see to it that how the change in sales are going to affect the EPS of the company in a particular manner, and this is how the complete entire leverage will be derived through the degree of combined leverage. Moving further, let's see the theoretical section. What does it want to say? Degree of financial, it is a leverage ratio that measures sensitivity of a company's earning per share with respect to fluctuation in operating income. See, due to sales, operating income will fluctuate, and due to operating income fluctuation, EPS will fluctuate. And this is as a result of changes in capital structure. If you are going to sales or the capital structure, as the case maybe, if the company is not related with the capital structure of debt, then the company may be under the threat of sales decline. Now here specifically it is been given that, sir, from the finance viewpoint, sir, if there are more debt in the capital structure of particular company, the company is under a tremendous pressure to earn at least so much, or at least so much amount, so that it can pay off its fixed capital commitment to the lenders. Moving forward, what will happen is it measures the percentage change in EPS for a unit change in EBIT. If my operating income change, how it is going to affect my EPS, that will be shown through the degree of financial leverage, sir. Moving forward in the same direction, sir, evaluates what? Operating leverage evaluates that how much operating income of a company will change, how much the operating income of a company will change in response to the change in sales, how much is operating income will change in response to the change in sales. This is shown through the operating leverage. Companies with a larger proportion of fixed cost and no variable, company with a larger proportion of fixed cost to variable cost will have higher level of operating leverage. Yes, sales decline or the expenses increase, both will lead to the decrease in the operating income for a particular company. Degree of operating leverage, if we think about the concept of degree of operating leverage, through various formulas it can be prescribed. It has been given on the screen. What does it want to say? It wants to say that the degree of operating leverage equal to percentage change in operating income divided by percentage change in sales. That means, yes, sir, if there is a change in sales, there will be change in net or the operating income. Degree of operating leverage can also be decided or can be derived through operating income divided by contribution margin. That means, contribution margin divided by operating income. That means operating income will change to contribution margin accordingly change. And the next formula which can be used for operating leverage is that the Q into P minus V divided by Q into P minus V minus F. What does it want to say? The Q is the number of units. That means if we are trying to derive the per unit data, that in this case it will be used. Sir, Q equal to quantity per data or the number of units, price per unit, V equal to variable cost per unit, and F equal to fixed cost per unit. That means if we are using the concept of marginal costing over here, we can using that concept also we can derive the degree of operating leverage. Because in short, in any of the formula which we saw right now, that means one thing is common: change in sales will give you change in operating income, and sometimes change in operating income also provides you the change in contribution margin, and this is how the degree of operating leverage has been defined under the respective area. Moving forward, degree of combined leverage. Yes, a degree of combined leverage, sir. What does it want to say? Degree of combined leverage means, sir, if there is a change in the sales level of your company, how will, if there's a change in the sales level of your company, how will it is going to affect your EPS? It is known as combined leverage. Combined leverage, by using the operating leverage and financial leverage, a smaller change in sales is magnified to larger scale, that is known as change in EPS. The multiplier effect is called the degree of combined. Yes, we have the multiplier effect is known as degree of combined leverage, that we have seen, that we have discussed. So what do you mean by term combined leverage? Now, if we try to see the formula, sir, of the combined leverage, what do you want to say, sir? If there is a percentage change in sales, there is percentage change in EPS. If there is percentage change in sales, there is percentage change in EPS. And as a result, we can also say that if you want to derive the degree of combined leverage, it can be derived through the formula of degree of operating leverage multiplied by degree of financial leverage. That means if both of the leverages, operating leverage and financial leverage get combined, it will give you the combined effect that if there is a change in $1 of a sale, how it is going to affect the EPS of a particular company. If we see in the income statement format, sir, from sales to EBITDA, it is the basis of the, sir, or it is the degree of operating leverage, and from the degree of operating leverage from EBITDA to PAT, it will derive the financial leverage. That means from sales to EPS, this is how been, sir, this is how been your combined leverage has been defined, which is being shown in a very particular manner. Hello friends, next topic that we are going to discuss today is the operating profit margin. What do you mean by term operating profit margin? The term operating profit margin needs to say that out of the total sales revenue, how much the company considered it as its profit, or how much the company is generating through its operating businesses, that is been described through the operating profit margin. Now if you look into the formula, its formula says that operating margin divided by net sales into 100. Sir, what does it actually wants to say? Sir, it wants to say that, sir, out of the sales made, how much is the profit which is attributable for the operating purpose? Yes sir, operating purpose. Sir, is there any other thing which has been included in the sales revenue? Yes sir, many other things are also included in the sales revenue, but operating profit margin initially and sir specially tells you that, sir, how much of the profit the company considers is as a operating margin or a operating profit. Now if we talk about the net profit margin, sir, what does net profit margin wants to say? So the net profit margin wants to say that, sir, how much amount of profit from the sales revenue made by the company is actually belonging to the company, is actually the profit. That means net profit means the actual profit which is been earned by the company. Now sir, if we talk about the net profit has been derived by deducting the means trading expenses also, in various supportive expenses also, that means the non-trading expenses also. Now if you talk about non-trading expenses like all the miscellaneous expense or supporting expense like electricity bill or telephone bill, if we talk about, or any other supportive activities and so on. That means if a company has made a sales of $100 and if the company is earning a net margin of $25, that means out of the $100 company its profit is $25, which has been actually earned by the company, and that's why its formula also says, sir, and that's why its formula also says that net profit margin equal to net profit divided by sales into 100. That means out of the sales revenue made by the company, how much amount of net profit is being made by the company during a particular year. If we talk about the next ratio, friends, what does the next ratio wants to say? Sir, the next ratio wants to say about the return on assets. How much or in what way the assets employed in your company, how much or in what way the assets invested in your company are helping you to generate the income. That means if I say, if you have collected the capital from the shareholders or from the stockholders, that amount if you are investing in your own business, then in such case you will invest in the assets of the company, and those assets will help you to generate the return for a company. We also need to calculate the percentage of the same also, so that we can know that in the generation of revenue for a particular company, how much amount is been contributed by the assets. And that is the thing which is, sir, which has been said. It has been said that, sir, if and sir, it wants to say only that, sir, in generating the income, how much amount is been contributed by the capital invested in the company, and we are having the capital investment in our assets only, and that is being what been said by the formula also. Sir, this formula says that net income divided by average total assets. Sir, net income means, sir, whatever you are earning, in average total assets. Sir, why here the word average total assets has been used? Sir, here the word average is been used because, sir, assets we are not calculating for a particular period, assets we are calculating for a particular date, because on the balance sheet, when we are preparing the balance sheet, or rather we say statement of financial position, in that we used to write as a statement of financial position as on a particular date. That means How much assets are being used during the year to generate the revenue, that is not possible for us. So we are calculating the average of all the assets, and we are considering that yes, on an average this amount of assets, had helped us in generating the net income for a particular period, and that is when it is been said a net income divided by average total assets into 100. Moreover, return on total assets is used in various other fields, like sir, for the profitability generation. It also keeps a check on the efficiency of the managers. It also help us to have the projected forecasted earnings of the same. Next, sir, it also help us to planning, budgeting, and all such matters which we can develop and sir move further, so that the return on assets can be generated more in an efficient and proper way for a particular organization. This is how the return on total assets helps us for the benefit of a particular company. Next topic that we are going to see is the return on equity. What do you mean by the term equity? Equity means the owner's fund. That means it is specifically belonging to the owners of the company, and those are nothing but the shareholders. Now, if we talk about their return on equity, what does the return on equity wants to say? Now, shareholders have given funds to the company for the better use of those funds and for the earning the profitability for the company. Now, the company itself wants to and needs to disclose the information to the shareholders that out of $100 invested by you in this company, how much amount of return it is being generated by the efficient use of that money. Once again, this ratio wants to say, if a shareholder has invested $100 in this company, how much amount of return is generated, by the efficient use, of that resources, that is $100 by the company for the betterment of the shareholders, and this is being shown by the return on equity. Now if we look if we look at the formula of the same, if you look in the formula wants to say, sir, net income divided by shareholders equity. Yes sir, we have discussed so many times and still repeating. What do you in the particular formula in the ratio chapter, anything which is given in the denominator, should be considered as a base for which appropriate numerator shall be derived, or it should be compared with the appropriate numerator. What does it wants to say? Sir, net income divided by shareholders equity, and that only we have been discussed that out of $100 invested in a particular entity by the shareholders, how much amount of return is being generated through it, and this shows that how the company is efficiently using the equities resources in the betterment of the company and its shareholders. Return on invested capital. Now, what does the term return on invested capital mean? So, return on invested capital means, sir, it is combination of return on assets and return on equity. So, it is combination of return on assets and return on equity. Why is it considered as a return on assets and return on equity? Because whatever amount we are investing in the capital, basically in the form of equity, whatever amount we are basically investing in the company in the form of equity share capital, when we receive the amount from the equity shareholders or the stockholders, then that amount is going to be invested in the business in the form of assets. Now I can say that, sir, basically if you talk about a statement of financial position, if you specifically talk about a statement of financial position, both the sides are getting balanced, sir. Both the sides are getting balanced. If, sir, both the sides are getting balanced, that, sir, what does it wants to say? Sir, it wants to say that if both the sides are getting balanced, that amount from shareholders is been invested into capital, and they both helps the company to generate the income, and that is what return on invested capital says. So return on assets and return on equity, when they both have combined, they shows that, sir, how much amount is been invested by the company and how much return is been generated by the company in the form of given capital. So, sir, sir, if I tell you the summary of the same. We are required to do the return on equity properly, we are required to do the return on assets properly, and when we combine both the thing, we can say that that yes, this is the amount which has been generated by us in the form of return through the capital invested in a particular business. Next is return on net operating assets. What do you mean by term return on net operating assets? Before that we need to understand the concept of net operating asset. What do you mean by term net operating asset? Net operating assets means your operating assets minus operating liabilities. Now what do you mean by the term operating assets and operating liabilities? If we keep it simple, operating assets and operating liabilities are those assets and liabilities which helps us to operate the business effectively, For example, if we have made an investment in some, other company, that means we have purchased a debenture of some other company, or we have purchased a shares of some other company, such amount or such assets, though they are assets, but such assets are not helping us in deriving the benefit within our company. That means those assets which they will not help us to generate the sales revenue, those assets will not help us to generate the income, and so many things, and that is the reason those are considered as a non-operating income. And operating income may be considered the assets or the cash balance or all such things which effectively and practically helps us to generate the income. That's why, sir, for the net operating asset, it has been said that operating assets excluding non-operating assets minus operating liabilities excluding non-operating liabilities, and this is how the concept of non-operating or the net operating assets have been generated. Now if we look into the theoretical portion, it has been said the same only. Now if you look into the formula, what does the formula want to say, sir? It is net operating profit after tax divided by total assets minus financial assets. Net operating profit after tax divided by total assets minus financial assets. That means as we have discussed, financial asset, that is the, if we keep it simple, that means all other assets that we have generated by making investment at some other place. And that is the reason it has been said, sir, we have to consider specifically those assets which are practically and effectively helping us to generate the income. And which income? Profit after tax. That means the profit which is exclusively available with us for the distribution, and hence it has been derived through return on net operating assets. If we look into the theoretical portion, it has been said that definition of operating assets and operating liabilities, it is given. Operating assets means your total assets minus your non-operating assets, and operating liabilities means total liabilities minus non-operating liabilities. Sir, factors in measuring income. Sir, if we consider factors in measuring income, sir, there are various factors which have been considered while measuring the income. That is, sir, what type of accounting methods we are using, that will also help us. Means, sir, for example, if for the purpose of inventory valuation we are using either the first in first out method, that is a FIFO method, or last in last out method, that is last in first out method, that is a LIFO method, it will change my profitability and it will change my income. So we need that. So there are various factors which are to be considered while determining the income, like accounting estimate what we are making, accounting method that we are making, and then a diversity among the users, and all such matters which are considered for measuring the income, and which will be considered for the ratio analysis. We have discussed in the basics of the ratio analysis that why the ratio analysis is being made, because we are able to give detailed information in various form to various users of the financial statement. We are able to give various detailed information to various users of the financial statement, and that is the reason that it has been said that there are various factors which are need to be considered while determining the measuring the income of a particular company. Next topic that we are going to discuss is a sustainable growth rate. What do you mean by the term sustainable growth rate? A sustainable growth rate wants to say that out of the amount which we have earned from our business, how much amount we are retaining with us for our growth. Once again, the amount which we have earned from the business, that is our earnings, and how much amount from that earnings we are retaining in the business for our growth. Now if we consider, sir, for our growth, that means, sir, it should be considered after the payment of all dividends also, including equity dividend. Means sir, if I am earning $100, out of that I am considering my $100 as my income available to equity shareholders or the stockholder. That means I have already made the payment of preferred shareholders or the preferred stockholders. After making payment of preferred stockholders, I am having an amount of $100. I am having amount of $100, and out of the $100 I am required to pay certain amount to the normal stockholders or the equity stockholders. Now after making payment to them, some amount would be remaining with me. Some amount would be remaining with me that would be used in the business for the growth of the business. Yes, and that is known as sustainable growth rate. That with the use of that money, how much amount, with the use of that money, how much growth we are going to make, because that is the amount exclusively available with the company for its own growth. Because we have made the payment of all liabilities, we have made the payment of all type of dividends and so on. Now that is the amount remaining exclusively with the company for its own growth, and due to which, if the company is having sustainable growth rate, we will check into the formula. If the company is having a sustainable growth rate, then in such case it can be helpful for the borrowing also. If the company wants to borrow from some financial institution or bank, it can be helpful. For capital acquisition also, if the company want to go for capital acquisition, for cash flow projection, for profitability margin, and there are many other factors which will be considered and which will be highly affected by the sustainable growth rate. Now as we have discussed the concept that amount which is remaining after making payment of dividend, amount which is remaining after making the amount which is remaining after making payment of dividend, that means we have to consider the amount which is solely exclusively available with the company, which has been shown through the formula which has been described below. Now we are going to make the payment of earnings, of dividend through the earnings available, and the amount which is available, which is after making the payment of the dividend, which it will be exclusively available with the company, and which has been shown by the given formula in the given presentation. That's how the equity portion or the earning portion which has been derived, it's been divided and bifurcated, and many details are being generated, and how the earnings are being kept by the company for its own purpose or for the growth purpose, that is known as sustainable growth rate. If we look into the formula, of the sustainable growth rate, first of all, using the opening stockholders equity, we are going to derive the income, and on the basis of that income, after deducting the dividend, we are going to get the earning which is been remaining after dividend, and this is how your beginning stockholders equity is helping you to derive the earnings after dividend, and that is nothing but if we say that your return on equity, whatever is your return on equity, out of that portion you are retaining certain portion with them, that is known as retention ratio. After the return on equity generated by you are retaining certain portion for the benefit or for the growth of the company, that is known as retention ratio, and this is how both this concept help us to derive the sustainable growth rate. Now if we look about the sustainable growth rate, it would be very useful for the company for many other purposes, like company wants to get the cash flow projection, any heavy finance or heavy project company want to acquire, so many things, and so sustainable growth rate determines the going concern consistency of a particular business for a long term purpose. Now if we look into the next concept, that is EBITDA margin. EBITDA, what it stands for? EBITDA stands for earning before interest, taxes, depreciation, amortization. That means this portion includes the depreciation and amortization deduction which is still not been deducted. Now what the company wants to say that, see, your profitability will decrease if we deduct the amortization and depreciation expense which are non-cash expense. So if we deduct amortization and depreciation expense, we can get the cash profit, somewhat a cash profit. Now what will happen if we compare the EBITDA and EBIT, that is earning before interest and tax, that is coming after deducting the depreciation and amortization? What will happen? Company will be able to analyze its non-cash charges, that how much portion is the non-cash charges which is been borne by the P&L and which is reducing its profitability. And yes, due to that the company will be able to analyze its cash portion as well as non-cash portions properly. Now if we consider this, sir, company mainly uses this ratio to calculate or to derive that out of the total amount of sales made, out of the total amount of sales made, how much is the EBITDA? Out of the total amount of sales made, how much is the EBITDA? That means if I am earning sales of $100, if I am having an earning of sales of $100, how much amount is the EBITDA? How much amount is the EBITDA? And that will help us to help the company to know that how much is the earnings which is earned by the company, how much is the earnings which has been earned by the company before before deducting non-cash charges, that is including those charges, that is the main income for the company. Other deduction like depreciation, amortization, which has been charged due to some legal compliance and due to some other concept, but these are going to affect the profitability, which can and which will and which is reducing the income of the company on a particular, which is reducing the income of a company on a particular basis, and which will in effect if you reduce the EPS or the dividend to be declared to the shareholders. And that is the reason company needs to look at this ratio in a most proper